outlook for precious metals for 2023 and beyond. So joining me here on the stage, I have Darren Cooke, Chief Executive Officer at Auteco Minerals, Samson Lee, Private Investor, and Phil Russo, Chief Executive Officer at Toubani Resources. So thanks everyone for joining me today. So I thought a good place to start is really just kind of looking at the macro environment. How is inflation, the Fed rate hikes, China's years-long slowdown, the whole geopolitical environment that we're currently in? How are all these factors impacting the precious metals markets today? Where do you see markets heading as we continue through 2023? So, I thought it'd be interesting to have kind of an investor as well as some miners on the stage to kind of give us different perspectives on how they see the market. So maybe Samson, if you want to kick us off.
Well, I think right now, everyone knows like what's going on in the financial sector. Like, the Western banks are having troubles, and I believe it's not the end of the story yet, because as long as the Fed will continue to either maintaining the current interest rates at the current levels or even keep on hiking it in the next few months, like even 25 basis points every time, I expect it will become even more a drag to the whole financial sector. So I would actually expect more bombs or like negative surprises out from the banks, particularly from the Western side. But whether it's European one or the American ones, it's hard to determine yet. I think both banks from the both continents have their own issues, but I would not be surprised it would be actually the European ones having more trouble. However, this is how I view things. First of all, obviously, despite the gold price have been doing quite well, relatively speaking, it has been mostly on fair trade. So especially when you are looking at the share prices of large gold miners, for example, like the XAU index, they have been lagging far behind compared to the precious metals itself. I saw on Twitter, someone saying, right now, the valuation of XAU, the North American gold and precious silver mining index, the valuation right now is trading as if gold price is at 1,100 or 1,300. So there's obviously a valuation gap between the gold miners and the physical price, metal price. Secondly, I also think, personally, I think it's quite obvious that someone behind probably financial institutions working on behalf of the Fed or the US government is they are already manipulating the gold price. So every time the last 2 weeks, whenever the market is in fear mode and then gold price spiked to above $2,000 per ounce, we can see immediate slam by someone in the market, pushing the gold price back down below $2,000. But frankly speaking, if you're a fund manager, how confident are you saying that based on fundamentals, you think gold price above $2,000 is overbought? I don't think anyone would dare to short the gold contract whenever the gold price is above $2,000, because probably no one, even the Fed, does not know how serious or how deep the problems is in the financial system. So amazingly, in the last 2 or 3 weeks, none of the closing price of the gold price was actually staying above $2,000. So I think there's obvious price manipulation here. So, and then moving forward, I think the market is already expecting the Fed will cut rates sometime this year. I think as of last week, the market is expecting about 1% cuts by the end of this year. And in theory, it should be good and bullish to gold price. But in reality, I'm actually expecting once the cut is confirmed, I think actually the market money is actually flowing back into technology companies. So that means whether the Fed will maintain its current high level of interest rate, or they actually start cutting the interest rate this year, gold price will always get the shorter end of the stick.
Thanks, Amy. Yeah, look, I'd like to reiterate a lot of Samson's points about the macroeconomic factors. And look, from a gold explorer's point of view, we're very bullish on the outlook for both the gold price and the equity market. As Samson alluded to, at the moment, there's a real disconnect between the real gold price and what we're seeing in the equity market and how gold stocks are being valued. And I think as 23 goes on, we will see that start to correct. And during these corrections, what we normally see is the first group of equities to run are the producers, because they obviously have the direct exposure to real gold price. Once they run, people start looking at your next level of developers, such as your Bellevue Gold and hopefully Auteco Minerals as we continue to advance our project. And then the money flows into junior exploration. And I'm sure that will happen by the end of 2023. But one interesting point and observation, it's been really hard being a junior gold explorer recently. It's been tough to get equity. It's been tough times for junior gold explorers. And what you will have noticed is that a lot of the gold explorers have all of a sudden become lithium explorers or copper explorers, or they've transformed into battery metals and the latest IT metal. And when the market turns for gold equities, there is a real lack of quality junior explorers out there. And I think it's a great time to buy junior gold explorers that are quality, that have stuck with gold as their key focus. And, long-term investors will be rewarded in the junior space.
So I have a rule. I try to keep it really simple when I'm trying to understand how the gold price is behaving, and I look towards some motherhood statements here, and that is, can you really mount an argument that gold becomes less relevant going forward or more relevant? And I think it's how do you view the health of the financial system and all those sorts of things going on. So I think it's a tick that gold still has a role to play going forward. And as long as gold is healthy, then when the equities get their moment in the sun is a matter of time. And so this is a good time to pick wisely. But, we've seen interest rates rise, US dollar strong, but yet gold stayed relevant. So that's a positive. Then you see the banking crisis in the US, US dollar weakened, surprisingly. And so gold still stayed relevant. And then you see these currency wars going on now with the Chinese yuan and with Russia and Saudi Arabia and Iran. And so you've got all these things going on. So do you really see gold cratering? I find that hard to sort of believe. And so from a macro perspective, I'm pretty constructive.
I'm wondering if maybe we can kind of continue on that, talking about gold's relevance, especially, you talked about a lot of miners turning to, or explorers turning to the battery materials or other factors. At some of the events that we were at last year, there was a lot of talk about kind of the crypto and why that was interesting to the younger generation. So yeah, maybe we can talk a little bit more about kind of gold's role, its place, and relevance a bit further. Maybe Phil.
Yeah, relevance in an investor's portfolio. Yeah, look, I don't think I'm saying anything new that diversification in any portfolio is the right way to play it. I wouldn't want to be long and strong all the EV future-facing metals. I think gold always has a role to play in there. And if you want maximum leverage, pick your right junior gold stocks. If you have a basket of stocks across multiple commodities, I think that's your best protection for overall performance in your portfolio.
Yeah, look, I think gold will always maintain its relevance. One of the things that we've noticed is that last year in 2022, and this has been well documented, central banks have bought more gold than ever. I think they bought 1,136 tons of gold last year. So that tells you that the guys that control the banking system do see a future in gold. We've seen the hiccups in cryptocurrency. The thing that always does my head in about cryptocurrency is what to stop you inventing a new coin, Bitcoin, Dogecoin, whatever else, right? How do you assign relevance to which one's important? So I think gold is physical, and even when you take aside all of the banking and the financial values of gold, there's still a huge demand for gold in the jewelry space, and India is a huge consumer. We're seeing middle-class China become huge consumers of gold. So it's not just the financial relevance, but gold is also relevant from its actual uses as well. And when you analyze the major gold producers, their reserves are getting smaller, right? And, we haven't, really invested the way we should in junior explorers because, let's face it, a lot of the big discoveries are made by juniors who then get taken out by the majors. When there's a lack of financial support for juniors, long term, I think, the reserves are declining and, just a supply and demand will eventually force gold up. So it will stay relevant.
I think gold's relevancy will be getting bigger and bigger in the future years, particularly to maybe retail investors and people like outside of, mostly people in the countries of like developing and emerging countries. As Darren mentioned earlier, the central banks have been, buying lots of gold, physical gold last year, reaching historical high. But to be honest, the gold price last year was kind of little bit disappointing. It has been doing quite well if you compare to stocks or cryptos and stuff like that. But in a catastrophic market like last year, at least for me, I was expecting much higher gold price or return for gold last year. I think part of the reason is back to the manipulation theory that I suggested earlier, because, even central banks are buying gold. I would think maybe they are buying on a non-leverage basis. So they are paying $100 to buy $100 worth of physical gold. But at the same time, the manipulators, they keep shorting gold contracts on futures exchange, like on leverage. So it's kind of far easier to manipulate gold price or suppressing gold price through a leverage platform than physical platform. So, but for example, when we see China, they start buying gold reserves again, starting the end of last year. And then we also seeing, in the last few weeks, China are doing deals with other emerging countries like Brazil, Saudi Arabia, and Russia on the possibility of doing deals, skipping through the US dollars. So I think in the longer run, particularly those developing and emerging countries, they will be trying to relying less and less on the US dollars for trade or for capital reservation. So I think gold will definitely be one of the more important choice of assets or capital preservation for these countries. Obviously, the Western world, particularly the US, they will try to put down the importance of gold. So this is why I think they are trying their best to suppress gold price below $2,000. But to people, retail people, even in the US, in the Western world, I think they will start to increase their investment in the precious metals more and more.
Do we have any questions from the audience before we kind of continue on? I kind of want to change topics a little bit. All right. So I think it was Phil that was starting to talk, or Darren that was starting to talk about kind of dwindling reserves. And so this, the reserve replenishment issue has been brought up quite a bit. how is the industry addressing this challenge? Is it, M&A, brownfield development? What are some of the strategies for kind of addressing kind of the lack of new big discoveries, or whoever wants to start?
Yeah, with the large producers, clearly they're mining faster than they can replace it. And the trap the industry got into itself, call it a decade ago, was increasing their gold prices to bring in more reserves. And so, fast forward 10 years to today, I don't think they've fallen into that trap the last few years, but I think it is a risk that they, instead of, new discoveries in terms of bringing in new reserves, they try and add these lower grade material, these higher cost ounces in to keep their reserve bases full. And so clearly that has ramifications down the track in terms of your profitability and all these sorts of things when you're bringing in these marginal ounces. And so that's a risk for the industry. I don't think they're doing it today, but it is a risk, I think, going forward.
Yeah, sort of as I mentioned before, I think there's a real lack of investment in early stage exploration into juniors, and quite often in the past, majors have seeded a lot of that exploration, and that hasn't been happening as much as what it would have happened previously. But they still do rely on the juniors' exploration success for reserve and resource increases. And, we've seen some recent movement in Canada where, for example, one of the junior explorers called Great Bear got taken out by Kinross for $1.4 billion US on the back of the Dixie discovery. In Australia, we're anticipating that eventually someone will have a look at someone like De Grey, who have done a really great job discovering a world-class deposit where people didn't think there was a lot of potential for gold. So, I think as an industry, the majors do have a responsibility to really assist some of the junior end of the spectrum. What we're also seeing is a lot more government assistance in terms of supporting both gold and critical mineral exploration, because people do recognise the importance to the economy. In Canada, for example, there's this tax incentive scheme called flow-throughs where, companies can raise funds to drill and explore at a premium rather than a discount on the equity market. So I think hopefully, as these reserves start to diminish, the gold price goes up, the governments will recognise the importance of incentivising good exploration.
Okay.
I think, sure, the gold reserves are, decreasing because we are running out of the minerals, and obviously the investment in the upstream has been kind of lacking in the last few years, not just gold, but same thing can apply to many other minerals as well. But I think that one of the bigger problems is about a lack of understanding from the buy side. In terms of buy side, I mean like generalist fund managers. I really don't think they, like many fund managers in the general space or the technology space, like they understand much about commodities. They usually just do half of their homework. They're just focusing on the demand. They don't understand, or they don't care much about supply. So like in order for generalists to come in, like obviously many things have to work right, but one of the easiest or one of the obvious thing is we need an increasing supply in order to attract the generalists to come into the gold sector, to invest in the gold sector.
And I suppose, looking at the junior end of the market, what would you say makes a junior an attractive investment opportunity? So, what are investors looking for? What makes for an interesting investment or not interesting investment?
Look, if I'm an investor looking at this junior space and picking their their gold stocks, there's a few things I would be paying attention to. One would be pathway to production. So can this, I'm assuming that the discovery's already been made, but are those ounces ever going to be, come out of the ground? Like there's so many companies out there that have orphan gold projects that won't go anywhere, don't get to that critical size on their own, and so that they can attract capital and eventually be built or bought. So that would be, I guess, my number one priority, pathway to permitting, pathway to funding. It's not all about grade. Like grade is important, of course, but not all deposits are equal. So you may have a large oxide deposit which is free digging, and so grade isn't the driver. But all those sort of factors, I think, come into when you're trying to select your junior gold stock.
Yeah, I think with the junior gold stock, what investors really want to see is upside and the potential to get a 10-bagger. Like everyone wants to make money. That's the aim of the game. And, one of the ways to do that is to keep exploring and keep finding gold. And what they need to see is a strong pathway and potential to keep growing, right? And what I also think that investors look at is the team behind it. Quite often, there's some geologists that are luckier than others. And it's not really luck. It's good management teams, good groups that have a long track record of discovery. And yeah, to Phil's point, you definitely want to make sure that ore bodies are mineable because like as Phil mentioned, not all gold deposits are equal, and you want to see a way to eventually be able to monetize an asset.
I think that recently, in the last few months, the brokers have a tendency to push some stories, mostly based on buck tonnage, low grade, low margin deposits to the buy side, because like under normal circumstances, if the sentiment in gold investment returns, then most likely these marginal deposits will mostly jump first. But to me, I think margin is important. Margin means like the profit margin. So like under normal circumstances, higher grade project could bring in higher margin. But as Phil said, grade is important, but not everything. It really depends on margin. So even like low grade oxide project may bring high margin to the economics. So like every deposit is different. But I think margin is quite important. For example, like last year, the Australian gold price have been hovering like near historical high last year. But the cumulative profit of the largest maybe 10 or 20 gold mining companies on the ASX are quite small. Why is that? Because, one obvious reasons is the cost of mining gold or producing an ounce of gold is jumping faster than the Australian gold price. So whether gold will become a better investment compared to other commodities, I would think margin is quite critical. And, the investment community will pay attention too.
And just to kind of follow along with that, M&A is kind of a largely talked about topic, especially within the gold sector. How can investors or companies, how do you spot an M&A target? What makes for, I suppose, also an attractive target? Is it different than the investment proposition?
Oh, I think in some ways there's a lot of similarities. So a corporate will still want to see that the asset can come out of the ground. So in terms of spotting an M&A target, I think that's similar. With respect to M&A in the sector, like it's always talked about M&A. It's never going to go away. But in today's market, when you've got a lot of depressed valuations, I think it's harder to transact. Companies have a view on their value, but the market has a view on the value. And so bridging those gaps is going to be, I think, some hurdles here in terms of the smaller caps coming together. So I think yeah, I think that's an obstacle here.
Yeah, look, it's it's a great opportunity when the markets are slightly depressed to actually grow a company through M&A. And I used to work for a company called Northern Star Resources for 7 years that basically built a multi-billion-dollar company out of doing M&A at a time when no one wanted to know about gold. They were buying assets off of majors when they were selling it. They were getting out of Australia, and really. Was unloved, and buying them at good prices and building up for a point into the future when things had improved. So, it's a great time to do M&A. There's two parts to M&A. There's the physical, monetary side, and then, as Phil alluded to, the cultural side, and whether people want to part with their assets, whether the M&A is actually accretive and adds value. That's where you have to be really careful. But the reality is, with a relatively distressed capital market, particularly in places like Canada, where there's a lot of good quality projects where they are struggling to get funding, there's opportunities to buy ounces cheaper than you can explore for them. But, you've just got to really target it very well to make sure that it adds long-term value, because we've seen a lot of examples where M&A for the sake of M&A just hasn't added value long-term to the shareholders of the original company.
I think under the current sentiment of the gold market, I think I would probably emphasize on neurology, meaning like, for example, if you have a big gold deposit in Finland, it is more likely the deposit will be acquired by a major company also working in Finland in the same country, because I think right now it's unlikely some companies would be willing to get into a new country that they are unfamiliar with for a new project. So I would definitely trying to guess the M&A angle from the neurology perspective.
Right. That was kind of it on my end with questions. Does the audience have any questions for the panelists? We've got one in the back. Can we get a microphone?
Hi, thanks a lot, guys. So Phil, you talked briefly about the currency wars. Samson, I think you mentioned that some countries have started to trade commodities using their own currencies. You guys have all been talking about central banks beefing up their gold reserves. Do you think that this is all just a transition to a new monetary system where they have a neutral reserve currency as a settlement asset between countries, i.e., do they settle their trade deficits or surpluses in physical gold?
I'll let Samson answer that one.
I think it's a possibility, but usually this kind of transition could take long time. Like I'm talking about decades, not months or years. So and then obviously many things could happen during the long waiting process. But especially, it's obviously beneficial to the US if the US dollar will maintain its supremacy in a global wide scale. Obviously, he also the US, they also start to notice the global system is trying to slowly shifting away from the dominant reliance on the US dollars. But I think the US will do something to try to maintain its hold of its dominance. So this is another reason why I think gold should play a bigger and bigger role in the long future, because to be honest, I am not too optimistic about the global geopolitics situation in the next 10 to 15 years. I expect the whole world will be far more messier than we are today in terms of geopoliticals. So that's why I think gold will be getting more and more important, both from a financial system of view and kind of, as a hedge against geopolitics issues in the long run.
Great, thanks. I understand the longer term nature of the thing, but you've just seen Brazil signing contracts with China. You've seen Russia signing contracts with China. You've seen Saudi Arabia settling contracts with China. They're literally about to start doing commodity trades in their own currencies. So it's not a long-term period. It's literally right now. And the question is what are they going to settle their trade in? So if you are Russia and you're sending oil to China and China are buying that with CNY, eventually you need to settle your capital account. And what do you think they're going to be settling in? Because it needs to be something. Traditionally, that has been US dollars. If we're moving away from US dollar system, there needs to be a settlement asset of kind. So I wonder what you think that might be, because they're literally signing the contracts right now.
Yeah, my guess will be settlement in yuan. That means, for example, like let's say Saudi Arabia is selling energy to China for yuan. And then in return, China may provide, I don't know, like some kind of electronics, products, or even infrastructure construction in Saudi Arabia in return for yuan. So like in theory, I think it might be some baby or first or early steps for yuan, Chinese yuan, to become, I'm trying to be a bigger market share of currency of trade in a global scale, or like early steps for yuan trying to be a fully convertible currency like sometime down the road. But to be honest, I don't see yuan will become a fully convertible global currency like in the next 3 to 5 years. Like it's a long-term game.
Yeah, let's hope it's gold.
But all of that you just discussed is pressure on the US dollar, right? So, and that, you can go through all the charts you like, but weaker US dollar, stronger gold price.
Thank you very much for our panel today.